Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to answer a question we come across frequently, and that's how or if you should change your investments over time, especially as you get closer to retirement.
Yeah, I'll add this in right away, but this has nothing to do with market timing.
Yeah, I'm glad you jumped in with that. I know some people would be shocked by it. But what we're going to do today is walk through a common situation for many people when it comes to investing for retirement, which is they choose their investment allocation sometime earlier in their career, then kind of leave things as is for many years and maybe don't even think about their investments much during that time. Then as they start getting closer to retirement, they start to think about their investments more, and specifically the idea that the way they invested when they were in their 30s maybe shouldn't be the same way they invest in their 50s or 60s. And as they're getting closer to retiring and needing to live off the money in their accounts, maybe they should adjust and make their investments less risky. So we're going to talk through this question and provide some perspective on how to think about investing throughout the course of your career and what changes to consider making over the years and why, especially as you approach retirement. So Andrew, why don't you kick things off for us by talking about investing time horizon and how to think about the way you invest relative to the time period you're investing for?
Sure. So starting out, we like to break down broad questions with a lot of gray area into something more tangible. Many people equate retirement to this key life event where all of a sudden you flip a switch and have to be in a certain investment allocation. However, this question isn't all that different from many other common questions of how to invest for certain goals. Instead of focusing on the event itself, retirement in this case, the real question is around your investing time horizon and how you should change your investments as your time horizon changes. We talk about this in episode 5, the 80-20 rule of investing, but one of the key principles of investing is that you want to match your investments with the time horizon of whatever you're investing for, whether that's retirement, college for the kids or grandkids, or buying a vacation home in 5 years. Once you know your investing time horizon, you can then back into how you should or should not change your investment allocation. And the reason it's important to understand your investment time horizon is because you'll invest differently based on different time horizons. For example, if you need money tomorrow versus 30 years from now, you have a different set of comfort with what happens the next day to your investments. When it comes to investing, there are essentially two basic types of investments, stocks and bonds, and the two behave differently from each other. Stocks have historically provided much higher returns, around 10% per year on average, but on the flip side, their prices also move around a lot more year to year. Some years they can be up 30%, other years they can be down 20%, and anywhere in between. Bonds, on the other hand, are much more stable and predictable than stocks over the near term. You don't have nearly the same amount of price fluctuations or volatility from year to year as you do with stocks, but because of that, they also give you lower returns, historically around 4 to 5%. And we define this price fluctuation or volatility of stocks and bonds as risk. With stocks, they carry more risk because they are less predictable over shorter periods of time, and it's tough to know what they'll do over the next month, year, or 3 years. However, the trade-off is that you're rewarded with higher returns than bonds over longer periods of time. Whereas bonds are less risky because they don't fluctuate in value nearly as much as stocks, or said differently, a bad day for stocks is often like a bad year for bonds. So when you hear about investing and risk and reward, there's this tendency for risk and reward to be correlated, where if you want the potential for a better reward, a higher investment return, you have to also be willing to accept greater risk, which comes in the form of unpredictability and price volatility. As an extreme example, you can think of it like investing in US government bonds versus investing in a small startup company that nobody's ever heard of. Sure, the startup company could become the next Amazon and you could earn a 10,000% return on your investment. However, it could also go bankrupt and you could lose everything. If you invest in the government bonds, on the other hand, you probably aren't going to become rich, but there's also a pretty low probability that you would actually lose money. So that's a high-level overview of the risk and reward dynamics of investing, which is an important starting point before deciding on how, if at all, you should adjust your investment mix based on your time horizon. The reason for this is because if you know you're going to need to use the money, or at least a portion of it, from your investments at a certain point in time, you don't want to run the risk that your investments will be worth less than what you paid for them, and either have to sell investments at a loss or not have the money you need when that time comes. Having said that, people often discount how long their investment time horizon is in retirement, and it's often more psychological than anything. If you look at a couple retiring at 60, and based on the average life expectancy, you can reasonably expect that at least one person will be around for the next 30 years. Which, stepping back, if you started saving at age 30, means your investing time horizon in retirement will be as long as the 30 years you spent saving. Once you have this context, you can avoid any overreactions of making a big change just because you are retiring, and instead focus on finding the right investment mix for you. And finding this right mix heading into retirement is about balancing having enough in quote-unquote safer investments like bonds or cash that you can use to fund your day-to-day lifestyle during those inevitable periods when the stock market is temporarily down, with having enough in stocks to ensure that your money grows and lasts over time to keep up with the rising cost of living. So there's always a possibility that you can experience a temporary decline in value of your investments. And unfortunately, the tricky part is that nobody can predict that in advance of when these declines will happen, how large they'll be, or how long they'll last. And because of that unpredictability, you want to avoid putting yourself in a position where one of these temporary declines could impact your ability to meet your monthly living expenses without jeopardizing your future years in retirement.
Exactly. Another way to think about time horizon and ability to meet future goals is looking at college costs. For example, if your son or daughter is a senior in high school, you probably wouldn't want to have their college fund invested 100% in stocks, because that's the money you're relying on to fund their education, and you know you'll need it within the next year, so you wouldn't want to run the risk of there being a bear market and their college fund declining by 20% or 30% right before having to use the money. And this timing dynamic also extends to retirement and the way you invest for it. When you're in your 20s and 30s and are early on in the process of saving and investing for retirement, you know you'll have decades before needing to actually use the money, so you can afford to be much more aggressive with the way you invest it. If your retirement savings are invested 100% in stocks and the stock market declines by 30%, it really shouldn't bother you because you have plenty of time to ride out the temporary decline and wait for your investments to recover. In fact, this can actually be a good thing since you're saving money to your accounts month after month, so you can view a decline in the stock market as stocks going on sale and giving you the opportunity to buy even more at a temporarily discounted price. On the other hand, if you have that same 100% stock investment portfolio, but you're 60 years old and have just started living off your investments when you retired last month, well, that same 30% decline would cause a lot more stress and anxiety, not to mention having a potentially significant impact on your retirement plans and your lifestyle. So the first point we want to make is that for most people, yes, you'll want to change your investments as you get older and get closer to retirement. And that change will usually consist of decreasing the risk or potential price volatility of your investment portfolio by reducing the percentage in stocks and increasing the percentage in bonds. That scenario I just mentioned of someone retiring and immediately experiencing a large stock market decline when they're starting to live off their investment portfolio is called sequence of returns risk. And it's the biggest risk we're concerned about and try to guard against when putting together a retirement plan. To provide a little more context here, when thinking about retiring and living off your investments, the most important thing, and this probably sounds obvious, is to make sure your investments last throughout the duration of your retirement so they can continue providing the money you need each year to pay for your living expenses. Most people plan to withdraw a certain dollar amount from their investments each year in retirement. So what can happen if your investment portfolio is too aggressive and you have bad investment returns right after retiring is that the value of your portfolio declines, and if you're withdrawing that same amount of money, that annual withdrawal becomes too large relative to the value of your portfolio, and your withdrawal rate becomes quote-unquote unsafe, which then runs the risk that your investments won't be able to grow enough in the future to keep pace with the amount of money you're withdrawing, and your investments could eventually be depleted. Experiencing the sequence of returns risk puts you in a tough spot because your options are then to either reduce the amount of money you're withdrawing to bring you back to a safe withdrawal rate, or hope that the market recovers quickly and then produces stronger returns in the future to make up for it. Neither option is great because it can be tough to reduce your living expenses to match that lower withdrawal amount, and there's never certainty when it comes to the stock market, especially with the timing and magnitude of market cycles.
Yeah, clearly you'd prefer to avoid having to make any adjustments to your lifestyle today or have to worry about jeopardizing your future retirement. But unfortunately, there is nothing you can do to control what happens in the stock or bond markets or how the timing of good versus bad periods play out relative to your retirement. But there are always ways that you can protect yourself against the risk of retiring during a bad period of the stock or bond market. The first obvious one is to have saved up enough or live a lifestyle where the amount you are withdrawing from your investments is a relatively small percentage to the point where you have extra wiggle room or buffer to account for these periods without needing to make adjustments. However, we know that isn't particularly helpful if you're not in that situation. So focusing on the things you can control, one option includes making temporary cutbacks in your lifestyle for a shorter period of time to allow your investments to recover and thus make the amount you withdraw continue at a sustainable pace. However, most people prefer to maintain their current lifestyle, and it's not always easy to cut back on spending. So a more attractive option is to focus on the way your money is invested and having the right investment mix to guard against this risk. And the biggest thing here is making sure you have enough money invested in bonds or cash that you can ride out these inevitable but temporary periods of bad stock market performance without stress, or at least minimizing the amount of stress. We refer to the bonds and cash portion of the portfolio as your war chest, and they become increasingly important as you approach retirement and the point where you start to withdraw from your investments to fund your retirement. The reason why this war chest, or having enough in bonds and cash, becomes increasingly important is that bonds provide a cushion or stability to an investment portfolio during periods when the stock market is down. During periods when the stock market is down, bonds tend to be steady or even increase in value. Yes, when the stock market is rising, bonds won't perform as well as stocks, but their purpose in an investment portfolio isn't to provide the growth, that's what stocks are for, but instead to provide stability. As a general rule of thumb, we like to hold at least 5 to 7 years worth of living expenses in bonds and cash as a part of the retirement investment portfolio. The reason why is that during those periods where the stock market is down, rather than selling stocks when they're temporarily down, you're able to withdraw the money to fund your living expenses from bonds and cash, which are likely to be much more steady. And there's no magic number here of how much you should have in bonds, but the reason for the 5 to 7 year guideline is that if you hold 5 to 7 years worth of living expenses in bonds and cash, that provides a long enough runway of time for the stock market to subsequently recover back to its previous value and likely higher. As we mentioned, the stock market is unpredictable over shorter periods of time, and nobody knows how long a stock market decline will last or when the stock market will regain its previous highs after experiencing a pullback. However, if you have this cushion of bonds and cash in your portfolio, it helps alleviate a ton of potential stress and gives you more breathing room because you know that you don't have to worry about what the stock market does over the next day, month, or year, knowing you can fund your lifestyle from your war chest of bonds and cash.
So bringing this back to the overall question of how should you adjust your investments over time, as you can see from this discussion, as you approach retirement and needing to withdraw from your portfolio, it's important to have enough of your portfolio invested in bonds and cash that you have a buffer to help protect against sequence of returns risk and allow you to sleep well at night. Now, what this translates into in terms of the exact percentage invested in stocks versus bonds will be different for everyone depending on their unique situation, including things like their living expenses and the size of their investment portfolio. For example, if someone has a $2.5 million investment portfolio and their annual living expenses in retirement are expected to be $150,000, then 7 years of living expenses would be a little over $1 million, which would equate to 40% of their investment portfolio. So in this basic example, that would be a portfolio of 60% stocks and 40% bonds. However, we're reluctant to even provide rules of thumb like this because everyone's situation is different, and there are often other nuances or considerations as well. For example, perhaps you're happy to add some part-time work if needed, so there's additional income that could be tapped, or maybe there's an inheritance that you expect to receive within the next few years that you could add to the portfolio. On the other hand, maybe your retirement goal isn't focused on your own lifetime, but instead focused on the next generation and leaving a legacy for them in some form or another. Another important thing to mention is that before actually retiring, you want to make sure you've run detailed retirement projections to ensure that the size of your investment portfolio is large enough to support your lifestyle throughout retirement. Going back to that example I just mentioned of someone who has annual living expenses of $150,000, if their investment portfolio is only $1 million and they'll need to withdraw $100,000 a year to cover the portion of their retirement paycheck not accounted for by Social Security or other income sources, well, that would mean withdrawing 10% of their investment portfolio annually, which means they would almost certainly run out of money within their lifetime, regardless of how their portfolio is invested and their mix of stocks and bonds. So the big first step in all of this analysis looking at investment strategy as you approach retirement is first establishing that you're on a sustainable path based on what you've been able to build up in savings and investments relative to your expenses. And I know we sound like a broken record when we say this, but when it comes to financial planning and investments, everyone's situation truly is unique. So what makes sense for one person won't necessarily make sense for another person, even if on the surface it looks like their situations are similar to each other. But hopefully that's helpful for understanding the rationale behind why you want to consider changing your investments as you get older and approach retirement, as well as some framework for how to think about exactly what that might look like in practice for your situation. Just to give a quick recap of the points we covered, number one of the most important concepts in investing is matching your investments with your time horizon. The stock market is unpredictable over shorter periods of time and experiences periodic declines, so when deciding on your mix of stocks and bonds, you want to avoid a situation where one of these temporary stock market corrections results in you not having the money to meet the goal you're investing for. Number two, applying this concept to investing for retirement, the big risk you want to guard against is sequence of returns risk, which is when you have bad timing with your investments and the stock market declines shortly after you begin withdrawing from your investment portfolio, and the size of your withdrawals becomes too large relative to the value of the portfolio, which runs the risk of you eventually running out of money in retirement because your investments can't grow fast enough to keep pace. Number three, one of the best ways to guard against sequence of returns risk is to have the right mix of stocks and bonds in your portfolio, where you have enough in bonds, which tend to be stable, that you can withdraw from them to fund your lifestyle during those periods where the stock market is down, so you can leave the stock portion of your portfolio as is and give it time for the market to eventually recover without causing you stress. And lastly, number four, The biggest overall point is that for most people, you'll want to change your investments as you get older and get closer to retirement. And that change will typically consist of decreasing the risk or price volatility of your investment portfolio by reducing the percentage in stocks and increasing the percentage in bonds. What this actually looks like in practice in terms of the specific investment portfolio will be different for each person depending on the specifics of their situation. Well, thank you as always to everyone for joining us for another episode of the show. You can find the show notes and the links for this episode at the podcast page of our website at mdwmllc.com/podcast. And if you have thoughts to share or questions you'd like to have answered, you're welcome to email us at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.